Yeah, I guess my problem with the whole PPT thing, and I've talked about it at some length before, is that it comes back to the fact that our government couldn't manage to hide one stained blue dress when Clinton was in office, and yet, here we have a cast of thousands. I mean, you think about it. Everybody on the trading desks at the New York Fed, okay, which would obviously have to be involved in this, plus all the big banks, and think about, how much money you make if you're one of those guys and you take proof of this, a data dump off a thumb drive or something, and you take it and you give it to George Soros. All right, I mean, how much would George Soros, who can stay out of the United States indefinitely, so they can't arrest him, how much money would George Soros make, releasing that information strategically, along with a huge short on the dollar or something like this? I have to believe that there is enough economic incentive out there to expose this. But the thing is, you don't really need to. I mean, we live in a world where you have all these little high frequency crashes. You have these computers that are passing shares back and forth that give a false impression of liquidity that doesn't really exist. And when it was only happening in little stocks that were very thinly traded, it didn't really, it raises your eyebrows because it's obviously cheating, but you don't, you're like, yeah, okay, this is going on forever. The old pump and dump scheme, right? We used to get phone calls from stockbrokers. Buy this, pink sheet thing. I still get faxes from these clowns all the time. But the last couple of months, Apple got hit twice, which is an amazingly liquid stock during the middle of the day. And then the other day, the SPY got hammered. They broke the trades in the latter. But, is there really anybody still out there actually buying and selling shares? I wonder if there's a few people like me that trade actively, but for the most part, institutionally and from an investment perspective, everybody's kind of taking their ball and bat and going home. Yeah, well, in which case, the market's really easy to manipulate. It's not hard at all.
Yeah, there are a couple of servers over in Jersey City that do most of the trading, from what I understand.
Well, yeah.
You don't pay New York rent, you see. Like the Apple trade, I took a look at the Apple trade, and, it is supposedly liquid, but if you take a look at it, it went quite a while without a bid, more than once.
Right.
I understand that there was a 1 million block, 1 million share block that went up, to market. But if it's supposed to be one of the, if not the most liquid equity instruments in the world, you'd think there'd be a bid. So it's not a matter of the price dropping; it's a matter of there was no bid. And my definition of liquidity is to have a bid and ask. Without one, then there is no liquidity.
Well, what I've been saying for a long time is that this whole high frequency trading thing is a load of crap, because if I sell you 100 shares of IBM and you sell the same 100 shares back to me, and we do this 1,000 times, it looks like there's 100,000 shares of liquidity in the system. In fact, there's only 100 shares of liquidity, and the guy who comes in with a 10,000 share sell order is going to find out there's no bid on the other side of the table.
Exactly.
And he finds that out when the price collapses. So because there's literally no one there. That's the big problem I have with what I'm seeing. And when I start to see these kinds of events happen in shares that supposedly have great depth to the market, it says to me that there's something critically wrong here, that we don't actually have people out there and institutions out there that are actually trading. All we've really got is a bunch of robots that are trying to find ways to game the system. Nanex has documented quite a bit of this, the ability of these firms to quote stuff and essentially create a time-based arbitrage that, for all intents and purposes, allows them to go back and place a bet on a horse race that's already been run. That sort of thing is outrageous, and yet we have no regulatory attempt to stop it. But how do you, as a trader, I mean, you make the very valid point. The fundamentals here suck. Okay, I mean, we just got another 450,000 unemployment claims, print this morning. Those have been going on for a year and a half now. I have some data I posted up this morning on gasoline and fuel oil demand that shows absolutely no recovery of any kind. Right, none.
Right.
How do you have recovery in the economy if there's no recovery in energy consumption? I mean, that's impossible. You've got the government that's literally spending 12% of GDP with borrowed money that they don't have, and that's hiding the impact of this. We have 40 million people on food stamps. I mean, you know the list. You've been down it yourself.
No,
Go ahead. I guess what I'm wondering, Reggie, is where do I have my own theories as to what causes this to break. I mean, I think this stuff with with Greenwood that was out. There's a story out on the wires saying that they're expecting to start filing some lawsuits here, that they've gotten over that 25% of the securitization hurdle for standing, and so we're going to be expecting to see some litigation activity from those guys. We had the announcement out from FHFA that they've retained a law firm, which strongly implies that they're going beyond issuing subpoenas and looking at documents and into trying to force some sort of resolution. How far does it go before the market wakes up to this?
Well, the bank stocks don't seem to care. Bank of America is probably the largest originator and servicer, or one of the two, after swallowing the entities that they did, primarily Merrill Lynch and Countrywide. Back in 2007, when I first started the blog, I took a look at Countrywide's REOs and simply added up the ones that they had on the website. And their REOs, the title is a very short blog post, a couple of sentences, and basically it said if you could remove all of Countrywide's problems, mortgage problems and bad debt problems, would you still buy the stock? And the reason why I pose the question is, even if all of Countrywide's problems went away on the debt side, they had 95% of their market value in REO properties, which is outrageous, and this was back in 2007. So,
that is ridiculous.
Yeah, Bank of America is the world's largest single-family REIT, basically. You laugh, but I haven't ran the numbers in a while, but it's not simply Bank of America. Many of the regional banks and definitely the larger banks that did volume production and then were I don't know if they were forced or voluntarily, but there is some logic to the fact they were coerced to buying the other large SIC producers and banks. They are being swamped in inventory and REOs. As a matter of fact, the delinquency rate, the foreclosure rate, has outstripped the delinquency rate. And when they catch up, you're simply going to have more foreclosures and you can have more REOs. It looks very ugly. It looks like it's going to get significantly uglier before it gets better. And most banks are not in the market to handle that type of real estate holding. If they were, even if they were, they either have to rent it, destroy it, or sell it. If they sell it,
right.
There's just no positive answer. If you destroy it, the value is gone. If you sell it, you're going to tank the market, but there's no activity in the market. Housing activity, as adjusted for inflation, is at an all-time low. Actually, not all-time. As adjusted for inflation, I think it's back to roughly the early 60s to early 70s. That
was the number that I'd seen too. Is that when you looked at it from an inflation adjusted standpoint, we were looking at like 1967 or something like this.
And that's awful, because do you realize how much this country has grown since '67?
Well, yeah, the number of people.
Right.
The number of people has gone up radically since then.
And then the number pushes back, and it's probably the worst in the history of the country once you do population growth.
Right. Right. So, yeah, I mean, I guess, my frustration with this is that I certainly understand that what the banks are trying to do. They literally, I'm sure they all literally realize that if they lose on this, and eventually I believe they will, that they're out of business. They're done. And there really isn't anything they can do about it. I mean, one of the basic premises is that when you make a bad loan, that's when the loss happens. You can try to figure out who you're going to shove it off on and how long it's going to be before it's recognized. But you can't make it go away. And so, once they did all of this stuff and we got into 07 and 08 and the recognition hit in the executive offices, it's kind of like sitting in a room with a locked door and there's a ticking nuclear bomb in the middle and you can't see the last 3 digits on the time. You hear it going tick, 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 but you don't know when it's going to get to zero.
You sound like you're a pretty good movie director.
Yeah, I mean, you know that it's going to go off. You just
well, this is the scenario. Let's assume that you're right, and everybody knows that the banks, have a big problem. Obviously, the recognition is out for Bank of America. I'm looking at their stock now, down another 31 cents. It was just almost $14 a couple of weeks ago. realized that Bank of America, J.P. Morgan, to a much lesser extent Wells Fargo, there are 5 banks, and the last time I checked was last year, but those 5 banks represented 96% of the notional derivative value outstanding.
Right. Well, that's a problem too.
and actually, I had my team look into it, and they backed into whether they were hedging with each other or not. But that was simply for empirical reasons. Realistically, you have 5 guys in a room out of 3,000, and they own 96% of the money loaned. They're basically lending to each other, and there's no way around it. Simple math. But we went into it, and they are, using each other as counterparties. And with that type of concentration, one bank brings down everything. When I did the CNBC interview, Herb Greenberg had asked me if I was bearish and short J.P. Morgan because of the risk concentration in derivatives. And I said, absolutely not. There's no need to be. You have 100% correlation. Once something goes wrong, everything falls, just like with Lehman Brothers and just like with Bear Stearns. And the issue is, nothing has changed from 2008. Absolutely nothing, except for the fact that the government's probably fine-tuned and honed some of its liquidity provisions, which, of course, they said they don't provide anymore, and backstops. But what was too big to fail in 2008 is much too bigger to fail in 2010. You have less counterparties, and those counterparties are bigger with higher concentration.
Yeah, one of the things that I don't understand about what they did back then, I certainly understand why Paulson corralled Bernanke and dragged Congress into a room and basically threatened the end of the world if they didn't get what they wanted. Goldman was certainly on the hook for more than enough to blow them up 4 or 5 times over, and there was no way that any of these guys were going to escape if it went off in their face. My problem with what they did was that instead of forcing those insolvent institutions through debt-to-equity cram-downs, which I presume they could have done, they instead let them merge and actually concentrate their risk even further. So, I just don't get it. Now you have a situation where you've got, between Goldman, Bank of America, Citigroup, and Wachovia, you have about $3 trillion worth of debt-based capitalization available to these organizations on their balance sheets. Yeah, but the problem is that, as you noted, you've got all this derivative cross-correlation and cross-exposure. You could conceivably, that $3 trillion is sufficient to absorb what has to be absorbed in these mortgage-backed securities and still leave some banks standing at the end of the day. But if you start triggering off these derivative contracts, then it doesn't make any difference what you do. What do you do with $500 trillion worth of notional value? Well, people say, well, that doesn't really count. And my answer and retort to that is that's only true so long as the counterparty on the other end can pay. You can only net against somebody that has money.
Thank you. And I have I've tried to drive that point home ad nauseum to the derivative traders on the street who really don't seem to understand. Listen, I'm not the smartest guy in the world, but I do understand it's a notional amount. It's a nominal amount. But as long as there's somebody else on the other side of the table, it denotes counterparty risk. $1 denotes $1 counterparty risk. $10 denotes $10. If you're netting, okay, I understand you're netting. But if you're netting against another party, you introduce more counterparty risk. As a matter of fact, you could actually take it and break it down to that net market value, net marketable value of the derivatives, and it's still too large, and it still outstrips most of the equity standing. But that's not the issue because you're talking market risk when you're discussing the market value of the derivatives. The notional value, you're talking counterparty risk. And that's exactly why the government had to jump to the aid of Bear Stearns. It's exactly why they allegedly let Lehman fall because they said there was no buyer. As a counterparty, when you have that higher correlation and everything drops, those companies that have no equity and everybody knows it, there's an instantaneous run on the bank.